Hi, welcome to the Intermediate Trader with me, Penny Lane Blaine. We're coming to you from the Place Your Trades Network. On the network, we discuss how you can use event contracts to trade futures markets such as the E-mini S&P, NASDAQ, crude oil, natty gas, and gold. Today's show is brought to you by Tradeovate, which has built a custom web app dedicated to trading event contracts. Click on the Tradeovate link to download the app to start trading event contracts. Jason, hi. Welcome to my brand new show called The Intermediate Trader. Did you know that was the name of it?
I did.
Mm-hmm.
I got the tweet.
Yeah,
So
sure. As you will. I feel like that's a little ballsy of me to just be like, and now I'm intermediate. But also I I think I might deserve stepping into that. I really went back and forth with can I call myself intermediate and decided to go ahead and do it.
yeah, I mean, look, I think that um, especially when you start, right? Like, everybody is just super novice, and as you graduate to different levels, like you could be an intermediate trader for years, until you get to that advanced
Years.
status. And even when you're in you get to that advanced status, the longer you're doing it, then you realize you're like, man, I was still kind of intermediate because, the longer you do it, the better you get. And, you should be saying with every year that passes by, especially after, if you're auditing yourself properly, that, hey, I'm a much better trader this year than I was last year. So, if novice, intermediate, advanced, the growth is always there year after year, especially after this year, because I know a lot of advanced traders that were just put on their ass this year, just because of all of the market conditions, and I think early 22 was kind of the easy trade, right? We knew that the Fed was going to tighten. That QE would end, and that they would start raising rates, and that was kind of the low-hanging fruit. But then what happened, kind of in between, from like I'd say the middle of March to even now, it's just been this whipsaw action where good news was uh, bad news and bad news was good news, and now we're trying to figure out, well, is bad news just bad news? And the market's just trying to recalibrate where it's at. So I think that this year we're all kind of intermediate traders because um, none of us have seen action like this, from the beginner to the advanced manager, um, at the institution or whatever.
Well, I also think that the longer you last in this game, I mean, I hope that 10 years from now, I look back at myself starting a podcast called The Intermediate Trader and laugh at myself, right? And think, oh, you were a baby. Like you knew nothing. But I've been talking, so this show is through the Place Your Trades Network, which, and this podcast is sponsored by Tradeovate, which has made a new app for event contracts. So it's daily options on futures. And I've talked with Anthony so many times about the biggest commodity that traders have is time in the market. And I love these event contracts for that because you can be in the market without, taking on a massive risk. So you're increasing your knowledge and your time in the market, which is, I think, so important. So I was saying, I hope that in 10 years I look back and think, oh, you knew nothing. But also, you're a Star Wars fan. I was wondering, as I was drying my hair getting ready for this interview, I was thinking about my love for Harry Potter. Are you a Harry Potter guy?
Yeah, I have some Harry Potter stuff. I got a couple wands in here. I got a sorting hat. I got kids and took them to
I
Hogwarts.
love that. I love that so much. Well, um, so I've watched all the director's cuts. I'm a big Harry Potter. And the director of The Prisoner of Azkaban was talking about that movie is really Harry's sophomore year. Like, it's no longer the happy, joyful magic. We're at Hogwarts. He's facing some real adversity. Sirius Black is in Azkaban. Things get dark. The tone of the movie gets darker. Like, shit gets really real in that movie. And talking about this idea of time as a commodity, things do get dark. Like, I feel you go into trading kind of like you're Willy Wonka in the chocolate factory. This is fun. This is great. This is amazing. And then the longer you stay in there, you're like, this is a little bit sick and twisted. Like, I've got to like really bear down to try to make it through this. And that has been such a mental shift for me the past year of like, you're not going to make it out of this the same way that you came in. And what a strength that will be if you make it out of this alive. Like, how much stronger of a person are you going to be? Because you go through some shit, some real mental warfare in
Right.
there.
Yeah, I mean, look, it's very true. Especially this year. It's, even for myself, it's tested my constitution. It's tested my ability to be objective, um, versus have that confirmation bias that you're looking for. And sometimes it's it's been difficult. I wouldn't even say sometimes. I'd say like week to week, it's been difficult. Kind of managing not just expectations, but things that you don't think should be happening, right? Um, and the market just kind of, it's like you get into puts based off of like all of this data, because, when you're getting this hardcore data um, every week, right? Which is very new to pretty much everybody. Nobody used to follow CPI number. Nobody used to follow ISM, PPI, non-farm payroll. It's just a minefield, right? So it's been difficult because um, you kind of see what's happening with the data, and then you see what's going on in your everyday life. The cost of goods going up. Um, in dealing with inflation, the impact of that. You're seeing these companies um, lay off people in mass. Then you're factoring in, well, what's going on, with the small businesses, which is a lagging indicator, and you're kind of hit with all of this stuff and trying to piece it together. And really, the only thing that you can do in this situation is account for being wrong, right? That despite everything that okay, everything that you see on the surface, it's kind of, think of it as like a hot stove, right? You see a hot stove, and like if you touch that hot stove, you're gonna burn your hand. But this market, it's like, okay, yeah, the stove's on. I touch it, and it's like, wait, why is it cold? Right? It doesn't make any sense. This should not be this way. So I think for especially newer traders, they have to come up with a strategy, a game plan, to account for all of these things. You know, their bias, their greed, their lack of understanding of data, and you know, you've got to, first and foremost, you have to normalize like taking your profits while it's there, right? You know, this is a market where, you know, and I'll use the example of the tortoise and the hare, right? Like every new trader wants to be the hare. They want to grow their account immediately. They want to build up, and they think like, I need to do this now. This is my opportunity. This is my shot. But in this market, the tortoise is going to win out every time, right? Because slow and steady will limit your, you know, your ability to not give back the gains while they're there. Because the one thing that this market is trying to do every single session is take it back from you, you know? So you've got to treat, you know, every green trade, no matter how small, you know, you got to take that win, you know. And it's, you know, if you're playing options or you're playing stock, it's really important right now because you need to preserve that capital. Because I think eventually, you know, whether you're, so I'm pretty bearish on the market. I think eventually that plays out. Now the time frame is really tough to nail down. Okay, and if it does play out, you want as much capital as possible to be able to play the upside. Because there's one thing that we've seen, even with conditions getting worse, the market wants to climb higher, right? It does not matter like how bad it is. And you know, I'll give like January 6th as an example. So we had this non-farm payroll, this ISM data, which was not good, and the market went from 380 to like 388 for no, and it was basically just gamma from options. You know, that kind of spiked it. Didn't make any sense. You know, then we push up into 390s. We've got the CPI data, which came in line, which, you know, if it came in line in November, the market wouldn't have ripped, right? It would have come down, and which we've seen. But instead, like, we push up and we come down. I mean, you know, the December data, we came lower, we shot up, we came down, right? But this market wants to push up, you know? So you know, like, there's a very real, like, need, okay, to expect the unexpected, right? If you're super bullish, you know, even if you're super bullish, have a hedge, you know, to the bear side. And if you're super bearish, have a hedge to the upside on these like headline event days, right? So now we'll have FOMC on the 1st, we'll have CPI on the 13th, and then this week we'll have Microsoft, Tesla, ASML, which, you know, it is really going to be the start of something, you know. And if you look at what happened with Netflix earnings weren't good. They just weren't. I mean, minus 93% year
CEO
over year.
stepped down.
Yeah, it's like, oh, but the market the market. It's like, we don't want to see the bad news, but oh look, subscribers are up. Woohoo! Let's rip, right?
Right.
And that's
Well,
what's
also,
happening.
we're recording this on Saturday. Sorry, I'm sorry to interrupt you. We're recording this on Saturday, but Friday, that news about the real estate market, you know, I'm in real estate. That news about the real estate market that we got yesterday was bad. Like, pending home sales are down. Last year in the real estate market was not good. market rips.
Yeah.
I,
And
how does a sane person...
well, so
Please
also
go. I
you've
just
got
want to
to
make that point.
you've got to recognize like the games being played in this market. So it's in I think it was late November, early December when they introduced 0 day options, like where the SPY has options every single day. That has like I don't want to sound like a conspiracy theorist, but that has messed up the market and created this one. It's a way they're basically just destroying people and collecting premium every single day, right? The bears are super bearish because all the data is saying be super bearish, and they are getting destroyed every single day. And I'm super bearish, so it's like, you know,
Same.
it it's been tough, and you're trying to press that short, and then you're like, okay, this data is not going to be good. Then the data comes out, it's not good, and the market rips, right? So you're kind of playing a game of like musical chairs with yourself. Um, but yeah, like the housing market and everything like that, one, you've got to have housing crash um, before, or level out before you can say, okay, bear market's over. Like that's the way it works. Um, and this whole that's the way it works idea has just not been working. You know, it's like the
No.
market is decoupled from the things that worked before, which is why I was saying like even the people that are advanced have never seen anything like this. So it's, tw- my expectations are 20, like if you thought 2022 was hard, that back half, the first half of 2023 is going to annihilate people. I've even
Yep.
considered, I'm like, maybe, just because of this action, just do less and wait, because there's more of a risk of me doing something like revenge trading or just kind of fighting this just because I'm so fed up with it that I expose myself to a lot of like downside versus I can wait
Mm-hmm.
and then get bullish again when I need to be bullish, because when this market gets bullish again, it's like we're going to 600. When the Fed does, like as soon as the Fed
Sure.
starts talking about QE, like it's it. It'll be like COVID lows again. But you've got to make it to that point. And
Yep.
that's something like that people should really try and understand, right? Preserve as much capital as possible to get to that point. Limit your losses, you know, bank your profit, take your profit, put it in something, um, treat every trade, every winning trade as if it didn't happen. Bank that profit, leave it in something like a JEPI, which pays, like a 10% dividend, and you just leave that as your bank. And then when it's time, you deploy, and then, you can make a lot of mistakes at a market bottom. But like even the bears that I know, the super bears, are making a lot of mistakes now, you know?
Sure. Sure. Okay, so there's one quick point I want to make is I'm a bear. Like my biggest days are big red days. People are scared. The downside comes so fast. Like I very bearish and I really like trading the downside. And the mental trick of like we're in a bear market, why aren't you killing it when this is what you trade well, can really take a toll on one's self-confidence, right? Like it's a hard thing to sort of fix in your mind. And I also want to go back to the analogy of the hot stove. which I love. You and I love an analogy. We really pop with an
Yeah.
analogy. But the hot stove. So on Twitter, I get a lot of advice, which I appreciate, but it's a lot of advice. And one of the pieces that I get the most is, we have numbers today, stay out of the market. Well, we have numbers ever. It's like, when's a good day to trade? Because there's always something. That stove is always on high. And you can't gain experience by sitting there and just looking at that stove. There has to be kind of a magic moment of when to get in, how can I be in this market without just getting torched. And that is also a very difficult game, because if you gain knowledge and experience by being in the market, but the market is too hot to be in, how does one do that?
I mean, that's a really tough question. And I think this question kind of goes to the novice to the intermediate, right? Now, the novice trader probably should wait, and see, take small swings. But as you graduate from novice to intermediate to advanced, what you find is, at least for myself anyway, like I don't like getting into the market uh, because the market is doing something. Meaning, like, okay, we get some bad data, all right, and I have no positions open, and then I'm like, okay, the data was bad, the market's going down. Okay, I'll buy puts. And then okay, I get out, right? Because I know one, we get a gap down. That gap down could have eaten up most of the trade, and vice versa. If I'm doing puts, calls, whatever. I like to be in the trade before it happens. Like a lot of times, too early. That's one thing that I'm notorious for, is getting into the trade too early when nobody thinks, hey, this is a good idea. And, as long as I've got time, that ends up playing out pretty well, and that really makes the difference, because you have to trust your ability to see things in the market that others don't see, to get in a trade that nobody likes, right? Like I'll give the example of like Carnival Cruise Lines. Okay, now Carnival Cruise Lines,
Your
like,
favorite.
yeah, I mean, especially because at True Trading Group, we've got everybody from novice to like super advanced. Like we have market makers, like retired market makers, as mods, as members, and a lot of people in between. And especially for like newer option traders, I always like to give them something that isn't the SPY, right? And what I find is on that lower volatility stuff, that's really slow, I end up making more money on those things versus, trading something that's as whippy as the SPY. And, I got into a trade, a couple times, but everybody's like, why are you getting into this? Why are you getting into this? The chart looks awful. And I was like, well, I've got a June contract, and it was like October. We're at like the October lows. And I was like, if Carnival can't get to 750 by June of 2023, I was like, it's got bigger problems. So, we get into an option, it's like $1.50,
Sure.
And nobody likes it. It goes up a little and then it pulls back with the market, and it goes red like 30%. People are like, freaking out. I'm like, look, we've got time. We've taken profit. We've added back. Let it play out, you know? The thing goes to like 1150, like 3 weeks later, you know? And what I always find is people don't like to buy it when it's like super cheap, when the option's like $1.50. They're always asking you when it's like 40-50% higher, you know? And in this market, you can't do that. I mean, you can, you know, and there is safety in that, but at some point you have to take a position, and you have to be confident in your thesis, right? You don't want to trade off of something that somebody else says, right? Not, I mean, look, you take advice from people, and that's fine, but you know, when you're right and you're early, there's always so much more upside, you know, whether you're playing options or you're buying stock, right? And you know, a lot of times people will say, well, why are you buying this stock? Don't you think it can go lower? Yeah, I hope it does. You know, it's like when Boeing was like $114 in the summer, you know, I started buying Boeing for my long term. And people are like, well, what if it goes down? I'm like, great, let it go down. Like, I don't mind. You know, you have to understand, like, you know, and I'm trying to explain it. I'm like, okay, well, their defense contracts alone are like $90 a share. I was like, so you're valuing the rest of their business at 20? And you know, people don't understand some of this nuance because they are so new, and you know that comes with time. But you know, I'd rather be early and you know, figure it out and see, you know, like take the correct approach. And the one thing I will say is, because I know that a lot of times I'm early, like the way that I protect myself is by managing my risk, creating a budget early, not going like, hey, I want to get in this full position right away. You know, I tier in, I wait, I see, is there a better strike, whatever. You know, and you've got to be comfortable with that. And, you know, at the same time, when it does work, sometimes that also plays against you, because you're like, I knew it, I knew I was right. And then you're like, I'm going to be super right. And then the market goes and surprises you, you know? So, you know, it's like before.
You know,
Go ahead.
I really love the way this leads into, I think my biggest asset is a trader, which I learned from you, which is just becoming a real expert in one thing and really narrowing your focus. And you're the best person I know at that. You just hyper focus on like 4 things at a time, and you just become the best at those things. And it's incredible. It's been incredible to watch, and it has been, I don't think there's anything that anyone has taught me or any advice I've gotten that has helped me more than just sort of canceling out the noise and just learning one thing. Like it's changed my life, honestly. And now I've got a lot of people trading IWM, obviously, which I got from you, which I like to think of as Apple's, you know, cousin. Apple's amazing. IWM's amazing. I just honestly wanted to thank you for that. What a gift. What a gift every morning to go to my computer and not think that I need to spend an hour looking for a trade. Either there's a trade or there's not a trade. That's,
Yeah.
you know, how simple my world has become. And anyway, I wanted to thank you for that very much.
Oh, you're welcome. Yeah, look, you know, and I think we started with Apple, right? Because I think everybody should become an expert at Apple, right? Because
Yep.
Apple is going to be such a big driver of what goes on in the market. Um, and I think because you were trading the SPY or the Qs, and I was like, look, don't trade those, okay? Um, those are the easiest way for new traders to lose money. If you want to trade an index, trade something slower like IWN, right? It'll be cheaper, you can get more time, and it's not going to whip around so much. Like it's not going to go up $10 in a day, you know, very rarely. It can. Um, it's not going to bury you, and you can have your stops, and if you need to like leave your station and go to the bathroom, you'll be okay. If you do that with the SPY, um, you can get absolutely destroyed. But this idea that um, oh, I have my scanners set up, and look, and I don't think that, like, I don't like thumb my nose at the people that use scanners, but my take is when you're seeing, when you're playing the scanner game, okay, also like that company GNS yesterday, everybody was talking about GNS, which is a dog shit company, okay, everybody is seeing the same things. So then everybody chases it, and then every trading room, um, you know, their mods or their head trade or whatever sees the same things. And then they're telling their people, this is where you want to take profit, and it's happening across the board. So then it becomes a game of musical chairs, especially in small caps, right? Like there's a couple rules that I live by, and it's never, or rules that I give new traders. It's never trade something you've never heard of before. Okay? Like just don't do it. Yeah, you can get these, like everybody wants to participate in those crazy like HKD moves. And if you can, great, you catch one, but over time, those things will take more money from you than anything else. Like if the stock market is a casino, then those like small caps and those no name companies are like the dingy slot machines that all the old people are playing on, just giving their money to, right? And if you focus on something like, like I like to break it down by sectors, okay? And I'll trade different things at different times of the year. So like if it's this time of year, the airlines usually perform pretty well from like January to like April. Okay, so maybe I'm playing airlines in this time period. Um, when is like tech really, having their best quarters? Okay, well maybe I play here. Um, and one thing is like if you do decide like, hey, I'm interested in this company, watch it. And the thing that I suggest doing, which is also pretty nuanced, which I do, is I'll buy one share of it. I'll buy one share in my trading account because I keep accounts separate. Buy one share, and I don't need to look at the levels because I'm seeing it every day, and it's creating like this muscle memory, right? And I'll understand like, oh, like your brain clocks it. And like I find that very helpful, right? So like I'm super bearish on this company called Ulta Beauty. And as much as I want to short it, I just can't, okay? Because I do not understand it. I do not understand it yet, and I haven't seen the opportunity. Now, I've been looking at this thing for like a month and a half, 2 months, and I still have not taken a position on it. And thank God I didn't, right? Because if I would have jumped in on this thing when it was like in the like under 430, I would have gotten killed like a million different ways. So I find doing stuff like that and just focusing on like become an expert at one company first. right? You become an expert on one company first. You're not going to be too surprised. You're gonna have confidence. Like it. Look, you get into a trade, whether it's puts or calls. There's always going to be that day where you're just surprised by something. Something goes the other way. But at least when you know the company, you know that you can dig yourself out. Maybe not on this trade, but maybe on the next trade. And you don't want to leapfrog from trade to trade and just trade whatever's like the flavor of the week or flavor of the day in the market, because that's a good way to like incrementally lose money, which is bad for capital preservation. Questions?
I also think it's so, as you get to know a ticker or a company or whatever it is, this thing that you're focusing on so well, I didn't really realize until maybe the last 6 months how important levels were, which is embarrassing to admit because they are very important. But getting to know those levels every single day and where good ad spots are or where the pivot points are or things like that versus just going into something totally blind and not knowing that information, you have such an edge on the other traders because you know it like a friend, like a person.
Yeah, and you're not having to consult a chart. And this goes back to, having that muscle memory on the stock, right? So, like if it's, let's say you just trade the SPY, like you should have all the levels like programmed into your head. Like I can think of levels all the way down and all the way up to like 460, right? And I don't have to consult the chart to figure it out. And it's the same with Apple. It's the same with a bunch of different companies. Now, not 100 companies, but a small group of companies, and which is primarily the ones that I trade to feed, my portfolio, right? And as like I know this is a trading podcast, but I think that in 10 years, maybe this won't be called the intermediate trader. It'll be called like the intermediate investor, because that's the thing that you need to realize is the more you trade, the more you put yourself at risk, right? It's kind of like jumping out of an airplane, right? You jump out and like, I don't know if you've ever gone skydiving, but so first time I went skydiving, like I didn't want to do the tandem thing where you're strapped to somebody because I thought that was kind of cheap. I took the
Sure.
course. I took the course, and they basically tell you every which way you're going to die. And you go through this process where they start putting pictures over your head, and they have you in like this mock thing, and it's like, okay, this is what you need to get rid of your chute. Your chute's messed up. And so I asked the guy, I was like, what are the chances my main chute doesn't open? He's like, your first jump? He's like, almost zero. He's like, never, rarely happens. And I was like, okay. And one of the members of TTG is a skydiver. He's like an avid skydiver. And I'm doing my one-on-one with him. And I was like, I never got to ask that follow-up question. So I asked him, I was like, if you jump 1,000 times, are you going to have a malfunction? He's like, oh yeah. And it's like, oh, okay. And that's what trading's like. Like, yeah, you get into a trade, you're not going to kill yourself, but there's always going to be that one trade, right, that can take it all away. And what you find is the way that you make money, and not just make money, but create wealth for yourself. Because, money is one thing, security and wealth is another. You've got to trade with a purpose, right? There has to be an end game to it. So that's why, I've gone over this with you, like the 50% rule, where you take like 50% of your profit and you bank it in a stock that has a good dividend, is going to be around in 10 years, 20 years, whatever it is. And if you do that, you're turning your trading account into kind of a video game where you're collecting these shares, and maybe you don't separate your accounts, maybe you do. What I've found is I've lost way more money trading than I have investing. And you always have to keep that in the back of your mind. Trading is a means to an end. You don't want to make it. You can't look at it as like, I'm gonna just trade and this is how I'm gonna make money, because there's also just all these implications for tax and risk. Like, you could have 4 good days in a row, and then on that 5th day you give it all back, and maybe you break even, and the novice trader will say, well, I didn't lose money this week. The advanced trader will say to the novice trader, so you worked 5 days this week and you've got nothing to show for it. You've lost a week of time. I was like, well, what's it called when you work for nothing? And they're like, and I'm like, slavery, right? And it's a loss because your time has a value. There is an opportunity cost with that. So, you always have to keep that in the back of your mind. Like, if you want to graduate, traders are going to trade, right? And there's a reason that the success rate for traders is like 10%. And that reason is they do not become investors. They do not sock that money away and put it to use. So, it's important to understand, the differences. And again, like, the investor is the tortoise, right? The trader is the hare. The same will be said, like, once we get out of this really tumultuous period in the market, one, you preserve capital. 2, you're getting free stock. A lot of people that probably watch this are under PDT. Well, this is how you build up to it. It doesn't come overnight. Very few people can build an account from a small account from like 1,500 to over PDT in under 6 months, unless they get very lucky. Now, I've seen it happen, especially during COVID, where you could make a lot of stupid mistakes and just get rewarded. That time will come. That when, like, you can just buy any call, like throw a dart at the wall and like, I'm going to buy YOLOs, and it rips. So
I cannot wait. I cannot wait.
I already have
suffering.
everything I'm going to buy.
I feel like I'm suffering through like the Great Depression, waiting for the Roaring 20s. I'm like, if I can just,
I know.
like, please.
So tough.
So tough. I want to ask you one more question. I want to get your opinion on capitulation. Do you think that it is coming, or do you think that we can create a bottom and go back up without some sort of capitulation?
I think in order to create a bottom, even though a lot of the things that worked before aren't really working, so like maybe something like the yield curve, like not inverting anymore, housing not bottoming before. I don't know, okay, but like I can't say definitively, but I can just tell you what I think, right? Which might not sound different, but they are kind of different. My feeling on the market is this. I think that there are a lot of these like technical factors that are pushing the market up, right? Like the bears are too bearish, and when the put call ratio gets as high as it is, the powers that be don't want to pay that out, and then like the market gets driven up on low volume or whatever it is, okay? At the same time, I think that the market is too optimistic and it's looking at things, it's focusing on the wrong thing. So right now, like the story is, oh, inflation's going down, right? Inflation's going down, the Fed's going to pivot.
Yep.
Not understanding that Fed pivots are notoriously bad for the market because if the Fed has to pivot, it means something in the economy is breaking, right? At some point, all of this bad news that has been driving the market up because they're like, oh, Fed's gonna pivot. They're not gonna, raise rates anymore. We're only gonna get two more hikes, whatever it is. I think that those chickens come home to roost. So the market is preparing or underprepared for the possibility of things getting bad, right? Earnings, okay? We're still going off of 2023 earnings. We haven't had revisions at all. People still think that Apple is going to crush, Microsoft is going to crush, that they're going to be higher than 2022. There's no way. And if you drop those earnings and you revise down, then you're looking at a very different S&P. Okay, so my take is, I think we need to come down to like a 14 PE. All right, which is like 330. 330 on the SPY. Now, will it get that low? I don't know. Especially with how gassed up this market is, because you are going to have like these tactical rallies. So, maybe the capitulation moment comes if, we're going to find out Tuesday, Microsoft has earnings. The bar is set very low. Then we have Tesla on Wednesday. Again, the bar is set very low. But it's going to come down to their forward guidance for 2023. And I think that all this talk about the Fed pivot and everything, I think that goes away in February for the CPI. All right, because, commodities are going up. Gasoline is up 8%, I think, in the last 2 weeks. Food inflation, which, it only makes up 13% of the CPI. Housing is another. Housing is a thing that's kind of keeping everything at bay because that's a lagging indicator. And now that's starting to catch up. And then, kind of the fuckery is they're going to measure CPI differently going forward, which is like smoke show. Right?
Wait, really?
Yeah. They're gonna like factor in like the way they currently do it. It's like housing, commodities, and then it's like food, energy, food, auto, health insurance, and then like whatever it is. And I don't know what that makeup is going to look like, nor do I know what the impact is going to be. But, maybe it makes the Fed look smart, which is a possibility. But I think that if the earnings, and we'll know, you'll know in the next 2 weeks when, I'd hate to base an entire trade off of Apple, okay? But Apple's going to be really the canary in the coal mine. And really,
Totally.
you could say Microsoft, and they've already said that they don't think that, that it's going to be down. Like, I know, because I've been tracking data, like PC sales in Q4 were down like 28%, or PC shipments. We know that Apple had to shut down their Foxconn facility in China. We know that their iPhone sales were not very good. Their services, which only it makes up, I think 20%. Like it's not going to be enough. I think it's either 20% or 10. I always get it confused with the wearables. You know, if you go to a site called Statista, it'll tell you, and you can do like breakdown of like Apple. You just Google like breakdown of Apple revenue, and you can see, you know, like the buying power of the consumer is down. Credit card debt is through the roof. Personal savings is at its lowest. And I think eventually all of these pockets of layoffs, which are happening everywhere, are going to affect the consumer. You know, now I remember after Black Friday, we got these headlines like, oh, you know, the biggest Black Friday ever, you know. Those numbers, and the market went up, obviously, but the markets, it was like, when you looked at it, it's like, well, adjust for inflation. So people got less, paid more. Inventories, they were basically getting rid of inventories. The more the average discount was 7% higher than the year before. And then we come to find out that 2022 ends up being one of the worst consumer retail years, right? So it's starting to have that pressure, you know, so, and also like you've got all of this, you know, foreign like central bank like intervention or impact. So like, you know, Bank of Japan is like buying yen like crazy. That's driving the dollar down. If you drive the dollar down, then the market goes up. But if you drive the dollar down too much, it's actually inflationary. And then the price of oil starts going up. And so that's why I said before, it's going to be, 2023 is also not going to be an easy trade.
Yeah.
You know, and you might be looking at, you know, if you look at the estimates for the end of 2023, I'd say like the average is like 380 for a close on the SPY, which is kind of nuts.
That is really nuts.
So, not an easy environment for sure.
Not an easy environment. What a test.
Yeah.
Well, Jason, there is no one I would rather have as my first guest on the new show.
Cheers,
And
glad to be here.
you certainly did not disappoint. I think that you and I have probably logged more time talking publicly than anybody else I've talked to, and I have enjoyed every second of it. I appreciate
that. Eventually I have
so
to get
much.
a podcast.
I mean, you keep telling me the market is ripe. I mean, everybody wants to hear your podcast. You just got to do it. You got to do it. You're so good on a podcast. We all want to hear it.
Yeah, I just don't want to talk about just stocks, right? It's boring to me.
I hear you.
Trying to get out of the game.
I hear you. You need a podcast about you as a person with just a little stocks thrown in. I feel like wherever the day takes you, you could really talk about.
Yeah, that'd be fun.
All right. Well, thank you. Thank you so much. And I hope we have many more conversations.
I'll see you at the 100th podcast.
Okay. Sounds good.
All right.